So my contribution margin ratio turns out to be $17.50. And I'm going to calculate my contribution margin ratio by taking $17.50, divide that by sales, because everything, of course, is divided by sales. So $17.50 divided by 25 is going to give me 70%. %70 even, okay? Plan 2, what do they say about that? The company will increase the selling price by 20%. Okay, so $25 increased by 20%. So I take 25 times 1.2 for the 20% increase, and that puts it at $30. So that means my sales price for Plan 2 is going to be $30. Everything else is going to stay the same. So I'm going to have $4, $2, $1, 50 cents. Okay, so that'll put it at $30 minus 750. Let's go minus 750.5. And that gives me $22.50. Then divide contribution margin by the sales. And that gives me 75% on the contribution margin ratio. Okay. Now that we know what our contribution margin ratio is, we can use that to figure out break even in sales dollars. Now, our dollar amount and contribution margin ratio has to be the same thing as total fixed cost for this to happen. So the dollar amount for contribution margin ratio is going to be consisting of the fixed cost of $200,000 and $325,000, because like I had pointed out earlier, fixed cost to get zero break even, then contribution margin has to be the same thing as fixed cost. Okay, so we're going to take $200,000 and $325,000, so that's going to give me $525,000, and I'm going to divide the contribution margin, which is what this is, by my ratio of 70%, and I'm going to do the same thing for Plan 2. So when I divide my contribution margin, which is my total fixed cost, same dollar amount, by the contribution margin ratios, I then get 750,000 and I get 700,000. This is my break even in sales dollars. Okay, so that's the answer to number 1. Compute the break even point in sales dollars for both Plan 1 and Plan 2. It'd be 750 and 700,000. Number 2, prepare a forecasted contribution margin income statement with 2 columns showing the expected results of Plans 1 and 2. The statement should report sales, total variable cost, contribution margin, total fixed cost, income before taxes, then the calculated income tax at 30%, and then net income. So we're actually going to wind up taking this income statement, and then we're going to subtract income tax at 30% to come up with net income. Okay, so we're just simply taking the contribution margin income statement and adding 2 more lines to it. Okay, so I went ahead and I started recording, writing out all of this stuff here, and I wrote out the dollar amounts for plan 1, and I'll go through plan 2. What I ended up doing was I put down 40,000 units for plan 1 because it said in here that under plan 1 that there's going to be same volume as last year, and the volume last year is 40,000 units. So I recorded 40,000 units above plan 1 so I could keep track of this. Plan 2 said that they will decrease unit sales volume by 10%. And so 10% of 40,000 is going to be 4,000, and subtract that from the 40,000 to get 36,000. So 40,000 minus 4,000 gives me 36,000 units. And I went ahead and I multiplied 40,000 by the sales of $25 per unit to get $1 million in sales. 40,000 times all of my variable costs, because this is variable cost, and that's all of these numbers right here: material, labor, variable overhead, variable selling, administration, which is $7.50. So that times 40,000 gives me 300,000, and I arrive at contribution margin. Then I subtract my fixed cost, which is what I have up here. My fixed cost is going to be taken out, which will give me net operating income of $175,000 even. And then I multiply that by my 30% tax rate, which gives me $52,500. Subtracting that will give me a net income of $122,500. Plan 2. I'm now going to use 36,000 units to do the same thing as I did over here, but it's going to be with 36,000 units. So that times my sale price per unit of $30, and I started writing it out, but I'll finish it up here. 36,000 times $30 per unit gives me $1,080,000 in sales. Then 36,000 times same variable cost of $750, so 36,000 times 7.5 is going to give me 270,000. That then gives me 810,000 contribution margin. I keep the same fixed cost of 525,000. To arrive at a net operating income of 285,000. So I take the 285,000 times my tax rate of 30%, so 0.3 is going to give me 85,500. Subtract that from 285,000, gives me a net income of 199,500. $122,500, $199,500. Plan 2 is your key right there. Thank you.